Hello and welcome to another episode of the Sunday segment, a place where I break down the 3 biggest financial news stories of the week. This week I talk about the possible fraud at the Nikola company, Berkshire Hathaway taking a stake in the Snowflake IPO, and Peloton hitting all-time highs. So let's get going with the video. As always, don't forget to hit that like button and hit that subscribe button so you don't miss out on any further videos. This week, shares in truck startup company Nikola fell dramatically after the company was highlighted by a short seller as being part of an intricate fraud and overstating its technology and its product launches. This news came only 2 days after General Motors announced that it had a $2 billion partnership in the company. First, let's talk a little bit about Nikola. Nikola is a truck startup company that's named after famous inventor Nikola Tesla. Sounds a lot like another electric vehicle company. Anyway, Nikola is focused on a truck segment of the market and is claimed to have produced full electric versions of trucks. The company listed earlier this year through an acquisition through a special purpose acquisition company, which listed the company directly onto the Nasdaq Stock Exchange. And because of the hype in electric vehicles, shares in Nikola company rose by 4 times. This is impressive growth from a company that doesn't even have a product and won't be even producing a product until 2022. And this is where issues have arisen for the company. On Thursday, Hindenburg Research, a short-selling company, posted research on their website to say that the company is an intricate fraud. Part of the report claims that the company has bought hardware that they were meant to be producing in-house, faked promotional video back in 2018, where a truck was rolled down the hill rather than driven down the hill because it has no capabilities of actually driving, and the founder has been employing his brother as Director of Hydrogen Production Infrastructure. However, his brother's prior experience in the role has been really just laying driveways in Hawaii. What has also become clear is key partners such as Worthington and Bosch have been selling all of their shares. In July and August, Worthington exited all of their Nikola shares. The report also claims that founder Trevor Milton has said outright lies as a way to form partnerships and boost the share price. And coming on to the CEO, the report also states that Trevor Milton has taken $70 million out of the company at IPO, renegotiated his lockup period, meaning that his shares are only locked up into the company for 180 days, meaning that after the 180 days after the IPO earlier in the year, he can sell as many shares as he wants. So seeing this big claim is obviously a massive story when one research company comes out to say that one company is a fraud. The first thing that I always want to do is understand exactly who's been doing the research. Hindenburg Research is a short seller. This means that the company profits when the stock of a company goes down, not up. This means that normally a company who is a short seller needs to focus on the bad news. They'll put bad news out into the market, hoping that drives the share price down, meaning that may make a profit. However, short selling comes with massive risks. When you put negative information out into the market, the company, shareholders, and sometimes the market don't thank you for it, even if it is true. This can mean great reputational damage for a company such as Hindenburg Research. So I always question when a short seller comes out and puts so much research, so much time, and so much resources into uncovering a company and saying that publicly the company is acting like a fraud, that actually the investment world should pay attention to this, because when a short seller comes out so publicly and risks its reputation, it shows that they are convinced that there has been some wrongdoings in the world and investors should know. I'm also saying that Nikola company has not been without its controversy. As stated in the report, Trevor Milton has sold $70 million worth of shares right at the start during IPO. Obviously this is a really bad luck for a founder who thinks that this company could be worth billions in the future. What did he do with that money? Did he reinvest it into the company? No, he went and bought the biggest house in Utah, a Gulfstream jet, and a private resort. That's not really the management who thinks that the product that they're producing is going to be a multi-billion-dollar company. And the news that GM took an 11% stake in the company pushed the share price up dramatically before the news of the short selling. However, this wasn't strictly GM spending $2 billion and buying a stake. If anything, Nikola gave GM 11% of the company to do the work which would have cost $2 billion. GM didn't pay any money out. This is clearly a win for GM, as they'll be able to do all the development and all the building for Nikola, and if it takes off, they'll have 11% of the company However, if it doesn't, it'll go to zero and they haven't lost out on anything. So this doesn't look good for the Nikola company, and as I like to say, if it looks like a rat, smells like a rat, moves like a rat, then it possibly is a rat. I'm not saying that there has been fraud, however there are question marks over the practices of the company and how the company makes money. There's also practices from the founder who's trying to cash out as much money as possible, which shows us a guy doesn't really trust his product. Personally, and this is not advice, you should always do your research, I would not come close to this company. This company has done nothing which shows that it's credible, and in the long term, really, is this something that is going to take off? Or is this a lot of hype right now? We'll wait and see. Next up, we have Berkshire Hathaway taking a £570 million stake in the Snowflake IPO. A couple of weeks ago, I talked about tech companies taking advantage of market conditions and listing. One of these companies was Snowflake, which provides data and cloud storage services and competes with the likes of Amazon Web Services and Microsoft's Azure. This was one of the most hotly topped IPOs for this year, valuing the company at over $20 billion. However, this week it was announced that Warren Buffett's Berkshire Hathaway will be taking a $570 million stake in the company at IPO. This means that Berkshire Hathaway will own around 2.5% of the company. And this is a very strange deal for a number of reasons. Berkshire Hathaway, the legendary investing company run by Warren Buffett and Charlie Munger, rarely invests in IPOs. And it rarely invests in tech companies. So this is a great departure from what they normally invest in, which is the likes of American Express, Bank of America, Coca-Cola and Geico. As part of this deal, Berkshire Hathaway will be signing up and buying $250 million worth of shares at IPO. And then we'll be buying 4 million shares from the founder and CEO at IPO price. This is a huge endorsement from one of the oldest and most well-regarded investing companies in the world. As Berkshire Hathaway are looking at the company, it will just fuel the hype for this IPO even more. However, this is such a big step for Berkshire Hathaway that this is massively newsworthy. First of all, Berkshire Hathaway rarely invests in an IPO. They have only done it once in the last 54 years. This is as Warren Buffett and Charlie Munger tend to steer clear of IPOs. The reason they steer clear from IPOs is because this is when the hype and the world is watching a company. They prefer to invest when no one else is looking at a company and the price is valued nice and cheaply so they can buy lots of shares. This is because the hype of an IPO is in the benefit of the company. The company wants to get as much money as possible when it lists to the public market. Therefore, it will create as much hype and as much marketing for that single asset on that day so that the highest share price can be achieved. This means that the founders or the early shareholders can exit at a nice high price, making as much money as possible. This is one reason why the investment from Berkshire Hathaway looks odd. The next is the fact that they're investing in a tech company. Warren Buffett has famously said that he's missed out on a number of tech companies just because it doesn't enter into his circle of competence. He normally invests in companies that he understands. He understands how banks work, with the likes of Bank of America. However, he has never felt comfortable with tech. More recently, Berkshire Hathaway has ventured into the tech scene, buying shares of Apple since 2016, and Apple now accounts for 50% of the market share of Berkshire Hathaway. However, going in for a tech startup, which is still loss-making, is so removed from a lot of what Berkshire Hathaway does, that it means that a lot of investors around the world are questioning what Warren Buffett is doing and what the company is now doing. Although it's a $570 million investment, it's actually a tiny slice of the $140 billion which the company has in cash. This means it's pretty low risk and is enough money to allow Warren Buffett and co. to see how this investment turns out. However, as it's such a big departure from the traditional investments that Warren Buffett and Charlie Munger have been doing, it shows about the next steps that Berkshire Hathaway will be going through. Nowadays, Warren Buffett and Charlie Munger are two men who are in their 90s. And whilst I want them to carry on investing forever, their time is slowly running out. And the next generation of Berkshire Hathaway leadership, the likes of Todd Combs and Ted Weschler, have been taking the reins and have been investing into different companies, such as Apple. This, to me, is a sign that Berkshire Hathaway is changing with the times, how it can't just sit there on the $140 billion that it currently has in the bank and how it wants to deploy more and more money. And with the new blood, with Coombs and Weschler, it will mean that the company is going to venture into different areas that it hasn't traditionally, such as tech and such as IPOs. This will be really interesting to watch over a number of years, and it will really highlight how a number of investors will change their philosophy and change the way that they invest as a company that is run by the successful investors, by Charlie Munger and Warren Buffett, changes their philosophy over time. Will we see Berkshire Hathaway start a tech fund and buy more companies like that? I very much doubt it, but we might see them venturing into tech more often and investing earlier into companies, as they've really been struggling to do that as they've grown their cash pile over a number of years. This is something which I'm going to be watching intently, as I have followed Berkshire Hathaway and the Berkshire Hathaway company for a number of years, and it's really shaped my investment philosophy. And finally, we talk about Peloton shares surging. Peloton, the at-home workout and fitness company which provides at-home classes for its stationary bike with a touchscreen, has performed incredibly well, beating Wall Street expectations on revenue and profit. Peloton's revenue grew by 172% over the year to over $600 million and posted a profit of $89 million. This was the first time in its history that it posted a profit. This is a result of strong gains from the pandemic, as people have been locked at home and wanting to exercise have bought Peloton bikes. This has resulted in a surge of demand for the bike, meaning that there are now longer waiting lists to get your hands on these £2,000 bikes. As a result of this, shares in the company rose by 10%. To me, Peloton is a really great company with a really strong business model. It supplies expensive stationary bikes which have a touchscreen. These have high profit margins, meaning that every time a bike is sold for around about £2,000 in the UK, the company is making a huge amount of profit on each sale. Also, an owner of the bike is required to pay subscription to Peloton to use its classes. This means that you basically have a spin class in your own home, as through the touchscreen you're streamed spin classes on demand and live, so you can follow along at home. To show how much the company has grown, subscription services have grown 333% year on year. With more and more people not feeling comfortable about going to gyms, going to spin classes and needing to work at home, then people are now forced to work out at home as well, which is great for the company. I think it's a fantastic company with great profit margins and a subscription business which keeps people glued to your product and keeps coming back over and over. I think this is just a start for Peloton, and is clearly a leader in the work from home space. Clearly they're going to benefit as people move their workouts from the gym and from outside into their home, where they feel safer and more comfortable. I think Peloton's definitely a company which is worth watching because of the high margins, because of the subscription method, and it'll be really interesting to see what other products Peloton bring online in the next coming years. Peloton is one of those companies which really highlights how the world is changing, how people are working and living from home and want things on demand in their home more and more. As always, I hope you've enjoyed this video, and let me know in the comment section below what other financial news articles that you found particularly interesting this week. And before you go, make sure you hit that like button and hit that subscribe button, and I'll see you next time.